Okay, let's go ahead and go through an example of a translation and consolidation when there's a differential. So in this example, assume that on January 1st, 2020, Big bought 80% of Little for 2,400 euros. The fair value of the non-controlling interest on that date was 600 euros. Assume that the book value of Little was 2,000 euros. Any and all differential is due to an amortizable asset with a 5-year life. And at the January 1st, 2020, the exchange rate was $1.10 per euro. We've got the exchange rates listed right there. The exchange rate is $1.10 per euro, so the dollar cost of that $2,400 euro investment was $2,640. Now, first, I want to note that space is at a premium here. Make this a little bit bigger. There we go. Space is at a premium here, so I simply have total sales revenue minus total expenses. Likewise, down the balance sheet, I've just simply got total assets. I've got the investment a little and the liabilities. I don't have room for a separate expense or a separate asset. So when we record this differential asset, we'll simply throw it into the category assets, and when we amortize it, we'll simply throw the amortization into the category expenses. Okay, so if the first order of business, I suppose, is we need to go ahead and compute the differential. So as always, we're going to have our 80% and the 100%, the cost, 2,400 euros, the total value. Our share is worth 2,400 euros, the non-controlling interest is worth 600 euros, total of 3,000 euros. Subtract out the book value. Total book value is 2,000 euros. Our share of that is 80%. For a differential, our share 800, total 1,000. As again, the assumption is that that entire differential is due to some sort of amortizable asset with a 5-year life, and so the annual amortization is going to be, again, total amortization 200, our share 80% of that, or 160. Okay, so now we're ready to go. We have our euro-denominated trial balance. We have our exchange rates. And so again, the first order of business is going to be to get the trial balance from euros into dollars by multiplying by the appropriate exchange rates. And again, this was a translation, so the choice of exchange rates is fairly straightforward. Assets and liabilities, we're going to record at the end of year rate of $1.20. Our paid in capital accounts, common stock, we're going to use at the date of acquisition rate, the historical rate. Retained earnings, as we'll see next year, retained earnings gets carried forward on the worksheet, but for the first year we have to use the date of acquisition exchange rate. Revenues and expenses, we'll use the average exchange rate over the course of the year. And dividends, we'll use the dividend date rate of $1.15. Okay, so the dollar equivalence, basically take the euro value, multiply that by the exchange rate, and that gives you the dollar figure. Okay, now again, the trial balance in euros balanced, just to confirm that, we have our debits minus our credits. That works out to 0, so our euro-denominated trial balance balanced. Since we're applying different exchange rates to different financial statement elements, the resulting dollar-denominated trial balance is not going to balance. And so we're going to need this plug figure, and so I'm going to do debits minus credits. So assets plus expenses plus dividends, so those are my total debits, minus my credits, liabilities, minus common stock, minus retained earnings, minus revenue. That gives me a plug figure of $217. Now again, my total debits, not meaning to beat a dead horse here, my total debits were $15,065. My total credits were $14,848. So my debits exceed my credits, so to make this thing balance, I need a credit of $217. Now again, OCI, other comprehensive income, is going to carry through as accumulated other comprehensive income. AOCI is an equity account, So since equity accounts normally have credit, since for an equity account credits are positive, I'm going to go ahead and maintain the convention that if this is a positive number, then that is other comprehensive income translation gain. Okay, if it was a debit balance to make this thing balance, that would be it would be a negative number, and it would be a translation loss. Okay, once we get all of this information in dollars, the euro information becomes irrelevant. The whole point was to get this thing in dollars. Now we can go ahead and populate our worksheet and commence with the consolidation in the usual fashion. So real quickly, just going down the list here, assets, 12,000, liabilities, liabilities, 8,400, common stock, 1,100, beginning retained earnings, 1,100, revenues, 4,248, expenses, 2,950, dividends, 115, and OCI translation gain, other comprehensive income, of 217. Okay, let's go ahead and think about that. What's the best way to do this? We sort of have a chicken and the egg problem here. We need to do our equity method entries, but we can't complete those until we know about the translation gain or loss, not only on the trial balance, but also the translation gain or loss on the differential. Let's go ahead and go through our elimination entries first. Okay, so our elimination entries. As usual, we eliminate the common stock, dollar value, we're going to eliminate beginning of year retained earnings, and we're going to create this differential asset. That total is going to be split 80-20 between the investment in little and the non-controlling interest. Okay. Beginning retained earnings, 1,100, common stock, 1,100. The asset, again, we had a $1,000 differential asset. Think again how this S entry is often viewed as, our beginning of year balances. We're carrying forward where we left off in the previous year. So we're going to go ahead and start by recording that differential asset at the beginning of year exchange rate. So 1,000 euros times the January 1st exchange rate of $1.10. Now again, it was 1,000 euros. These are dollars. You can't have dollar, dollar, and then a euro number. You got to convert that euro number to dollars. So we have a total of $3,300 there, and that's going to be split 80-20 between the parent's investment in little and the non-controlling interest. A for amortization. And again, I don't have a separate amortization expense. I'm simply going to call it expense. And I'm going to write off part of that asset. Now, the amortization is measured in euros. These are all euro numbers. The amortization is measured in euros. When we write that off, we're going to convert it to dollars at the average exchange rate. Again, we always use the average exchange rate for our expenses. So the expense is going to be 200 euros times the average rate of $1.18. Now, let's go ahead and record the AOCI associated with that right away. And to see what's going on here, notice that looking at our two elimination entries, in the S entry, we established an asset. Let's see if I can do this so it looks good. In the S entry, we established an asset with a value of $1,100. In the A entry, we amortized 236 of that. And so after doing that, the balance in that asset per those two entries is going to be 1336. That's right. I got that as a negative, so I got to add it. The balance per those two entries is going to be 864. Now, we measure our differential in terms of euros. At this point, we began the year with a 1,000 euro differential. We amortized 200 of that, and so there's 800 euros left. The remaining differential is 800 euros, and this is going to be the end of year asset value of that differential asset. Assets are reported at the end of year exchange rate. So the desired balance, I'll say at the end of year exchange rate of $1.20, the desired differential balance should be 800 times 1.2 or 960. Basically, we need to go ahead and say, look, because euros have become more valuable, this differential has become more valuable. We have a translation gain not only on the reported trial balance of the subsidiary, we've also got a translation gain on the differential. Basically, we have to write up that asset from its current value of 864 based upon create this, take away that. We have to write it up from 864 to 960 and increase. So plus that minus that, an increase of $96. So we're going to go ahead and write the asset up by $96, and that's going to be another form of other comprehensive income. Okay, now we're in a position to go ahead and, well, let's skip our equity method entries for the moment. So we have S, we have A for amortization with the, whoops, that should be an increase of the asset, sorry about that. We have an increase in the asset due to the translation gain. We have to go ahead and eliminate our investment income in the usual fashion. And again, we look at our trial balance and say, hey, look, there is investment income of $849.60. That has to be eliminated. We also need to eliminate the other comprehensive income from the subsidiary. Now, just to be safe here, think of the two forms of other comprehensive income that we have here. We've got 217 from the translation of the trial balance, plus we got 96 from the translation of the differential for a total of 313. That's going to be split 80-20 between the parent and the non-controlling interest. So 80% of that is going to be 250.4, which is exactly the number right there in our worksheet. The other 20% is going to go to the non-controlling interest. Whoops. When we get to the non-controlling interest entry. In any event, let's go ahead and do our investment income. We eliminate our regular investment income. We also have to eliminate the other comprehensive income of 250.4. D for dividends. Again, we're running short on space here. I'm awfully tempted just to bypass that, but I guess we shouldn't. We're going to take the cash dividends, $115 equivalent, and again, we credit dividends declared, and we're going to split that 80-20 between the investment in little and the non-controlling interest. So 80% of the dividends for the parent, 20% for the non-controlling interest. Okay, lastly, we have our income to the non-controlling shareholders. And the structure is going to be exactly like this. We're going to allocate to them a portion of the regular income, and we're going to allocate to them a portion of the translation gain. So the income to the non-controlling interest for the regular income. Now, how much regular income is there? Well, again, they get 20% of the subsidiaries' adjusted / realized earnings. So what does the subsidiary have as income? Well, they got revenues minus expenses, this is all in dollars, minus that additional amortization. Same as it's always been, the reported earnings of, what's that, about $1,300, minus the amortization of that differential. Okay, likewise, we're going to allocate to them a portion of the other comprehensive income. So again, I've already got the computation laid out here. The total other comprehensive income, 217 from the translation of the trial balance, another 96 from the translation of the differential, totals up to 313. The non-controlling shareholders get 20% of that, or 62.6. Okay, now it's a matter of taking all that stuff and posting it to the worksheet, same as we've always done with, again, this new other comprehensive income thrown into the pot. So let's go ahead and post this. Debit to common stock. A debit to beginning retained earnings, a debit to my assets for that differential, a credit to the investment in little, a credit to the non-controlling interest. Debit to expense, credit to the asset, debit to the asset, credit to the OCI translation gain, debit to investment income, credit to the investment in little, debit to OCI translation gain, credit to the investment in little, debit to the investment in little, debit to the non-controlling interest, credit to dividends declared, debit to the income of the non-controlling interest, credit to the non-controlling interest, debit to the OCI to the non-controlling interest, credit to the non-controlling interest. Okay, that was pretty long. Let's go ahead and confirm that my debits equal my credits. And so I'll sum up all my debits, sum up all my credits, so they balance, so that gives me some assurance that I didn't, with that many different entries and going back and forth, it's easy to miss one. But I'm pretty happy about that. Okay, lastly, before we go ahead and work through the consolidated column, let's go ahead and work our way down the big column and down the little column. So, big's net income. Revenues minus expenses plus investment income. Transfer that down to the statement of retained earnings. Get my ending retained earnings, so my beginning retained earnings plus income minus dividends. Transfer that down to the balance sheet. Okay, other comprehensive income. They have other comprehensive income of 250.4. Beginning AOCI is 0. Sort of started with the assumption, I should have been explicit, there's no beginning AOCI. Our OCI for the period is 250.4, so our ending OCI is 250.4, and that transfers down to the balance sheet. Likewise for the subsidiary, income, revenues minus expenses, transfer that down to the statement of retained earnings, get my ending retained earnings, and that goes down to my balance sheet as ending retained earnings. And lastly, my other comprehensive income. Again, they have OCI of 217. So accumulated other comprehensive income, beginning balance is 0 plus 217 gives us my ending balance, and that goes down as ending accumulated other comprehensive income. Now let's go ahead and work through the balance of our worksheet. Sales, we simply add across. Expenses, debit plus debit plus debit. Investment income, credit minus debit. Net income, working our way down the consolidated column. So combined revenues minus combined expenses, minus the income to the non-controlling interest. And so my income to the controlling interest is my consolidated income minus the share that goes to the non-controlling interest. And as always, that goes down to the statement of retained earnings. Continuing with the statement of retained earnings. Beginning credit plus credit minus debit. Dividends. Debit plus debit minus credit. Ending retained earnings, I work my way down again. So beginning retained earnings plus income minus dividends. And that goes down to my balance sheet as ending retained earnings. Now I can do the rest of my, well, let's go ahead and do this other comprehensive income. And here, you need to be careful. Again, there were two OCI figures. There was the other comprehensive income from the translation of the trial balance, and that's what's showing up on Little's column here. That's the 217 from their actual trial balance translation. There was also $96 from the translation of the differential. That is not included in Little's number. Again, the differential isn't included on Little's trial balance. The translation of that differential isn't included on Little's trial balance. And so what we're going to have is we're going to eliminate the subsidiaries, as always. We eliminate the parents' other comprehensive income, but then we're going to go ahead and tack on that additional $96. So credit plus credit minus debit plus credit is $313. A portion of that gets allocated to the non-controlling interest, and so the portion of the controlling interest is the total of $313 minus the share that went to the other people, which gives us the ending OCI to the controlling interest of $250.4. That goes down to our statement of accumulated other comprehensive income. So now let's go ahead and go through our statement of accumulated other comprehensive income. Beginning balance 0. So our ending AOCI, beginning balance plus OCI, is $250.4, and that goes down to the balance sheet. In the home stretch, adding across our assets, debit plus debit plus debit minus credit. Investment, debit plus debit minus credit. That goes to 0. That makes me happy. Liabilities, credit plus credit. Common stock, credit plus credit minus debit. Retained earnings and AOCI are already populated. Those are the numbers I brought down from up above. And finally, the non-controlling interest, credit minus debit. And now sort of the moment of truth, does our resulting balance sheet balance? So we have assets, that's our only debit, minus liabilities, minus common stock, minus retained earnings, minus AOCI, minus non-controlling interest. That goes to 0, so that makes me happy that my trial balance does in fact balance. Okay, this is 23 minutes long. I'm going to go ahead and stop this here, load it, process it, and then come back and do year 2. Year 2 is important, especially the first few minutes, because there we'll talk about how to carry forward the balance, carry forward the balances from one year to the next and how things carry forward.